the co-CEO label. First of all, congratulations. It's not a label we see too often, a co-CEO. How is it going to work at Oaktree?
Thank you, Katie, and I appreciate the opportunity to be on Real Yield. The co-CEO designation at Oaktree, yes, it is a new one, and you often don't see it. But myself and my partner, Bob O'Leary, who have been at the firm now 16 years in my case and over 20 years in Bob's case, we have worked together directly in our opportunities group for many, many years. And several years ago, I moved over to the performing credit strategies. Our partnership is very strong across all things Oaktree. We work very closely with both our credit areas and our non-credit areas, as well as our non-investment areas of the firm, having been here for so long. So we're not really dividing the world in terms of the opportunity set or the responsibilities. It is truly a partnership. But I will continue to oversee the performing credit strategies, and Bob will continue to see the opportunities group. And I think there's a tremendous amount of opportunity collectively at Oaktree, given the current market environment and the economic backdrop. So we're really excited to move forward and have to really build on the 30-year history of Oaktree, built by Howard Marks, Bruce Karsh, and the other co-founders. We're on really solid footing and excited and humbled by the opportunity to lead the firm going forward.
Well, let's talk about some of the opportunities in the market, because just a couple of weeks ago over at Super Return in Berlin, you called this period that we're in a new era of tight credit markets. Where are you seeing that tightness right now?
Yeah, we're seeing it across multiple areas. So first and foremost, the liquidity in the market is meaningfully lower today than what it was pre-COVID or even in 2021. We're not seeing a lot of trading volume. We're not seeing a lot of new issuance in high-yield bonds or in senior loans. And part of that is because there just aren't willing borrowers. And in the case of M&A activity, we're not seeing willing sellers at what are today depressed valuation multiples. It's really because at this point, we have hit a massive inflection point around rates, where we've had the inversion or the reversal of 40 years of downward movement in rates and about 12 or 13 years of easy money in the markets. With the rapid inflation that we've seen in the economy, the Fed, and they've said as much even this week, the Fed is very much of the opinion that it needs to raise rates to battle inflation to get to the point where we actually have real rates. In other words, rates in excess of the nominal inflationary picture. So that's, go ahead.
I was just going to say, of course, we've seen extraordinary happenings on the monetary policy front. I'm really curious, though, in the time that we have with you, to hear your thoughts on what we've seen in the banking sector, because I know you've made the point in the past that you're expecting tougher regulation ahead for U.S. banks. What opportunities would you expect that to create, and are you seeing those opportunities surface already?
Yes, absolutely. In the case of investment banks that use their balance sheets to commit to deals to syndicate to investors in the broadly syndicated side, a broadly syndicated loan side, or in the U.S. high yield bond side, we are seeing a reduction in access to those balance sheets and a reduction in the new issuance volume seen from those banks. It's really because the hung loans that were placed on the balance sheets in 2022 and were placed at massive discounts into the market in late 2022 and early 2023 really created a big hole in the bank balance sheets in the billions of dollars. And therefore, the risk desks and regulators are watching this very closely. In the case of the commercial banks or regional banks in the U.S., they have tremendous amounts of real estate loans and other corporate loans, as well as a Fed that has articulated a higher level of equity capital needed to manage those banks. And as a result, what we're seeing how that play through in the markets is a reduction in lending activity by commercial banks across the board, in real estate as well as corporate lending, which allows for private lending, non-regulated entities like investment managers such as Oaktree to step into that void and partner with banks in some cases, as well as just lend directly to borrowers for real estate as well as corporate lending that no longer have that incumbent lender available to them.
And I want to get to fundraising, but just quickly on that point, have you started to see banks start to offload some of that loans? There's a great story on the terminal to that effect, that basically you're seeing that already happen. Is that something that Oaktree is trying to take advantage of?
Yes, we have seen it begin, but it's only the beginning. I think the depth of that opportunity is yet to come. There have been some transactions. There have been many conversations, as well as discussions about partnership between the private lending universe, asset manager universe, with banks. But there are transactions of portfolios in both real estate and corporate lending that have already occurred. And based on the conversations, I think will continue to occur at a more rapid clip over the course of the next few quarters.
We'll hope to have you back to talk about those conversations. But let's talk about some other news from Oaktree in the past couple of days. You also announced the close of Oaktree's Life Science Lending Fund for $2.3 billion. Tell us a little bit about that sector and what are you looking at there?
Life sciences is an attractive industry from a lending perspective for multiple reasons. First of all, it requires specialized knowledge, and therefore it's a less efficient marketplace for competitors to lend in. We're able to get more attractive legal terms, better pricing, lower loan to values than you would typically see in other asset classes in the lending universe as a result of that. Second, life sciences companies are not GDP correlated. If a company is good at curing cancer, saving lives, changing lives, doesn't really matter if we're in a recession or having some sort of broad market dislocation. From a credit perspective, the company's performance makes it such that our loans to these businesses are well covered. So we really like that from a diversification standpoint in a broader credit portfolio to have uncorrelated assets that will not kind of have the same outcome as an industrial or consumer business might. So those are the two main reasons why we really like it. And the third, I would say, is there has been a meaningful reduction in the valuation multiples for these businesses since the pandemic. During the pandemic, they rallied very hard, and since then they are off 50, 60, 70%, which means that the cost of incurring or the cost of raising capital in the equity markets is prohibitively expensive for these companies at this point and too dilutive. And therefore, finding alternative solutions like the ones that we offer at Oaktree in our life sciences business are very attractive at the time, and we're seeing a meaningful increase in our deal pipeline.